This afternoon, we have Marketing and Firm Value by Shuba.
Thank you so much, Eric, and thanks to Frank and others at the MASB. As I mentioned, I came down COVID positive last week. I would have loved to be there, but I'm glad we could do this virtually, and I'm happy to report I'm having a very good recovery. So thanks for bearing with me on a virtual presentation. I'm going to be talking about results of research on marketing and firm value. And I want to thank my collaborators, Dominique Hanssens, who's no stranger to this group, for contributions to a book that he and I wrote. And I also want to acknowledge Alex Edeling, another co-author of mine. Over the next 45 minutes or so, I'm going to be talking about the evolution of metrics, the development of methods in the marketing finance interface, most importantly, focus on some generalizable findings, and a little bit on future research, not too much, and then talk about the conclusions from the stream of research. So what exactly is the marketing finance interface? It's basically the academic discipline of finance that has been linked with the field of marketing, and together it's referred to as research on the marketing finance interface. And MASB is very familiar with this because this is a topic that has to do with the relationship between marketing-related variables and metrics, incorporating the behavior of financial market participants such as analysts, investors, and creditors. The main objective of this research aligns itself very well with the objectives of MASB, which is to elevate marketing and to include investors as a relevant stakeholder within sort of the discipline. What are typical research questions? As I was listening this morning, a lot of these questions are things that the MASB is really concerned about. How does the company, what happens when companies build brands, launch new products, engage in marketing activities? How do they strengthen the long-term viability of the enterprise as well as the stock market? Another question, are managers influenced by investor behavior? For example, does the evolution of stock price impact the types of marketing firms engage in? So these are the sorts of big level questions or big picture questions that have been of interest to the marketing finance audience and researchers. So why is the marketing finance interface concerned with the stock price? The stock price is a recognized consensus metric of a firm's economic health. And marketers are well served by knowing which actions lift stock prices and which actions do not lift stock prices, and maybe which actions actually depress stock prices or have a negative impact on stock price. The one thing to keep in mind is there is a vast literature in finance on asset pricing, and they focused on things like efficient market hypothesis, which states that all value relevant information about firms is incorporated immediately and fully in their stock price. And the notion of efficient market hypothesis, it comes in three forms. The first is weak efficiency, where only historical information and nothing but historical information is incorporated. Semi-strong efficiency, which is the notion that historical data plus new information as it becomes available to the market is incorporated, and strong efficiency. Mike and I contend that marketing's role in the marketing finance interface really comes through the semi-strong efficiency notion. And why is that the case? That is because in general, marketing is always and almost always concerned with releasing new and publicly available information. So think of new products when they are introduced by the firm, information on how the new product is doing in the market slowly becomes available as time goes on, and that is new, but it's publicly available information. So the idea is that marketing actions typically are in sort of the semi-strong form of the efficient market hypothesis, that all else being equal, the stock market should reward firms with higher stock prices as good news becomes available. In contrast, when bad news becomes available, the stock market should punish those firms with lower stock prices. And the idea in this stream of research is that typically the stock market valuation is in sync with product market valuation. And as marketers, we all know how to measure product market valuation very well. And that's been the stream of research that's been going on and the focus of interest for a number of decades, understanding the impact on product market performance. And the idea is these actions should also drive firm value. So that's sort of the premise and the underlying philosophy behind why marketing should drive stock price. Let me pause here before or maybe I can get through one more slide because this is kind of something that people in this audience know all too well. Why is this important? The first, as I heard this morning, I think Kinshuk said that in the very first talk, demonstrating the impact of marketing actions such as advertising is a number one C-suite challenge. The CMO survey that Chris Moorman does shows that even though 11% of revenues are in marketing investments, only 41.6% of the firms in the CMO survey are able to quantify its impact. So think about that. That means 59% or a whopping majority of firms are still not able to precisely quantify the impact of marketing actions. The second is, I think I heard a little bit about this as well, the role of the CMO and the role of the CMO in driving growth, which unfortunately has not really taken off in the sense that we're now seeing shorter tenure of CMOs. The same survey found that the average tenure of a CMO is 3.5 years compared to 7.2 years for a CEO or 5.7 for CFO. The juniorization of the marketing staff, my colleague Susan and I have a bunch of papers where we've written about how the programmatic advertising and the shift to digital has meant that the classic brand stewardship that marketers and CMOs were responsible for has now been relegated, and the growth mandate of the CMO is sort of pushed to the background. Some other things that you see on the slide, marketers do not use stock prices, even though they are an ultimate metric of firm performance. And the marketing function is not responsible for the brand in most companies. But I think the top two buckets of marketing accountability and the role of the CMO are sort of really what's at stake here when we look at these questions. At the same time, the Business Roundtable and the move towards a multiple stakeholder perspective has meant that we as marketing scholars and practitioners should really be looking at not just customers, but also employees, suppliers, community, shareholders. I think I heard this theme about employees being a big driver of value as well this morning. And so now the marketing function needs to be cognizant of the fact that we need to address the needs of a broad range of stakeholders. And some of these pictures below show how important it is to consider the community, the role of environment, ESG initiatives and things like that. And so the marketing finance discipline is well equipped to tackle these big picture challenges of society. Let me pause here and see if there are any questions. If not, I'm happy to sort of delve into some of the results. When we did this review book, we found that there were about 300 articles. 243 of these published papers have appeared since 2009. So in the last decade or so, there's been an explosion of research in the top journals in marketing. And where are these papers on the marketing finance interface appearing within the marketing discipline? We did a survey of all these 285 papers, and we found that the Journal of Marketing, I don't know if you can see the colors clearly, but the Journal of Marketing is the blue line, and you can see that that's had about 85 of these 300 papers. The Journal of Marketing Research comes a close second. These are both academic AMA journals, which has 38 of these papers. Marketing Science, Journal of Academy of Marketing Science, and majority of these are in outlets with a strong managerial focus. So the JM and the JAMs are really concerned about topics that practitioners and managers care about. And interestingly, 59 studies are outside of marketing. A large number of papers are actually in the Journal of Finance, for example, 28 of them, which means that finance researchers are examining the impact of marketing on firm performance. So the field is alive and thriving. There's a huge upward trend in the number of scholars interested in this topic, and some of the best journals and researchers and the top institutions are working on these topics. We also did a survey on which topics are important from a marketing finance perspective. And here you will see that when it comes to the financial impact of marketing and marketing accountability, most of the researchers and people we surveyed are interested in research on that topic. Not surprising given what we know about not being able to quantify the impact of marketing. Then comes, the four P's. I've heard a lot of discussion about the four P's and the additional two P's. So understanding the four P's and the impact on firm value. The role of brands and marketing assets in general. There was some conversation this morning about the relative importance of brands versus customers. That's been a topic that's been researched a lot in this space. Understanding customer satisfaction. While a lot of research has focused on returns, recent research has focused on things like the risk and the volatility metrics, the role of innovation, the role of the chief marketing officer. And a topic that has really come to the forefront is understanding customer equity and customer relationship metrics such as churn and retention and how they determine the value of firms and firm value. So if you look at these topics, this looks seems a bit backward looking in the sense that most of these topics have already been researched. And so it'll be interesting to contrast this with directions of future research, which I will show you a bit later.
Shuba, a quick question on that one.
Yeah.
On the top point regarding the financial impact of marketing,
Yes.
we saw earlier today that there was much discussion about short-term immediate impacts and longer term impacts. Do you have any sense of those papers, how much time was devoted to each of those areas?
That's an excellent question. And I think that really gets at the heart of why it is important to study stock prices. In contrast to the traditional focus on, let's say, metrics like market share or immediate sales lift and so on, the stock price represents the net present value of future cash flows. And in some sense, this gives the long-term perspective in terms of what is the impact of my marketing in terms of a long-term impact. So metrics such as stock price or firm market cap inherently take the long-term view, and metrics such as sales and market share and revenues inherently, given that they focused on short-term lifts in terms of brand performance, are inherently short-term. So a lot of the results that I'm going to focus on today come from the stream of research that focuses on stock price. And so a lot of these findings are inherently what we refer to as the long-term impact of marketing.
And do you isolate for stock buybacks?
There was a question if you isolate for stock buybacks.
Yes, a lot of these studies increasingly have focused on understanding the relationship between stock buybacks and myopic marketing, for example. So yes, stock buybacks as a phenomenon has increased tremendously over time, and research in the space has accounted and looked into investments in stock buybacks, for example, versus investments in marketing, and how do firms that prioritize one over the other do in terms of long-term brand building, and it turns out not so well. So there's interesting research on that, but has looked at stock buybacks. Yes.
Have any of the research looked on return on net assets within an industry group?
Yes, yes. Today I'm going to be sharing with you results that focus primarily on firm value, but a lot of these studies have looked at return on assets. They typically use multiple metrics and assess robustness around these multiple metrics, and return on assets is one of them. And I think a lot of the generalizable findings have to do with these long-term performance metrics. These are great questions. Keep them coming. These are excellent questions. So this framework is a bit busy, but it really helps us organize what we are talking about when we synthesize the research in this space. So if you focus on the bottom half of the chart, you can see what we refer to as a marketing finance value chain, which is the idea that firms do stuff like marketing actions, which may be in the product space, which may be in price management, communication management, such as advertising expenditures, distribution management, such as channel addition, or in terms of managing customers, customer engagement initiatives, or they could take integrative actions such as CSR, corporate social responsibility activities. That then goes on to create what we call marketing assets, which is the second column in the bottom half of the chart. And this column here has marketing assets that come from two sources. One is sort of brand related assets, which are things like online and offline buzz, maybe earned social media volume, earned social media sentiment, mindset metrics, which have been a focus of my research, looking at things like the purchase funnel and what happens when advertising triggers consumers onto a purchase funnel. And so you have these funnel metrics that might be like awareness, consideration, and liking, all of which reflect measures of brand health. And then you have these customer behavior metrics and customer lifetime metrics, which are customer assets. That in turn leads to product market performance. Notice that I've grayed out the third box of product market performance. And the reason being, this goes back, I believe, to Eric's earlier question, because these are short-term metrics. And the stream of research is really more concerned about the long-term metrics, which are the financial market performance outcomes, such as equity-related metrics, levels of stock returns, risk and volatility metrics, such as idiosyncratic risk, what is the cash flow volatility, the metrics for young businesses, as well as the behavior of financial market participants. What is the impact of my marketing on analyst coverage and trading volume, and so on. On top of this, we overlay the fundamental foundation for how marketing transfers or converts these marketing actions into financial market performance. And we use the marketing organization framework of Chris Moorman and George Day, where the idea is that the capabilities, which are the skills, the knowledge, and the overall general capabilities available to the firm, the configuration, which are things like the structures, the metrics, the incentive systems, the alliances, the human capital, the role of employees, the role of leaders within the organization, the role of the chief marketing officer, the role of the chief executive officer, and then comes the culture, which is the values, the norms, and the behaviors within an organization. So a few things. The fonts in red, the letters in red are variables that have been researched in the last decade or so. So you can see there's a lot of new work emerging along the marketing organization front. For example, on human capital, a lot of the research on CMOs has emerged in the last few years. In terms of which are the variables that are studied the most, you can see the numbers within parentheses. Marketing actions, 215 mentions of this in the 300 studies, or assessments of this in the 300 studies, followed by marketing assets, 126 focus on marketing assets. And if you look at financial market performance, a lot of the studies have looked at equity-related metrics, things like stock returns, 194. And the reason these numbers don't sum up to the overall number of papers is because you have multiple metrics within a given sort of article. As I was mentioning earlier, return on assets is commonly used as a dependent variable in addition to stock returns. And so you see that they add up to more than 300. So what is the overall takeaway from here? We seem to know a lot about marketing actions, and we are adding more as we go along. Salesforce expenditures was mentioned this morning as an important topic, and we can see now that we are now adding more insights on this. Online and offline buzz, digital marketing is emerging in the asset space. And when it comes to financial market performance, we're seeing a lot more research that focuses on not just the levels of firm performance, but what is marketing doing to my volatility of cash flows? How is marketing helping me smooth out sort of my risk patterns when it comes to relative to other firms and relative to the market? So this is sort of a conceptual framework that allows us to sort out the results. Now, moving on to the method, unless there are questions here, let me pause here on this framework for a second and see if you have questions.
Hi, within the papers, your research, is there any focus on demand generation metrics?
Could you be a little more specific? I mean, if you think about it, marketing actions are all about generating demand. For example, when you have new products being introduced or new to the world product, it's all about creating demand for the brand. So in that sense, a lot of what we see in the marketing action space, such as new product introductions, 27 of those studies have focused on impact of new product introductions. Advertising expenditures are often about creating demand when you might have new products or when you have a product that's no longer performing as well, find out new ways to communicate benefits and so on. Channel addition, Walmart, when it entered Germany for the first time, it's about creating demand in a new country for the company. So in that sense, a lot of these do focus on demand. I don't know if I've understood your question, but is that
Because what
you had in mind?
We see a lot of, I would say, inspection and accountability around our demand generation metrics, how many inquiries, leads, marketing qualified leads, marketing sourced SAO pipeline, really focusing on the demand generation. What percentage of marketing sourced campaigns there are that are contributed to the book one in on a quarter-to-quarter basis. So we're seeing a lot of focus on those demand gen KPIs with an evaluation on a quarterly basis. So I was just wondering how that interacts with some of the longer term stock price looking at it. It's hard for us to get beyond a quarter view with our sales organization.
Right. That's an excellent question. And I think the way these studies have addressed that is through these marketing asset metrics, the notion of the funnel, right? How many, for example, looking at the role of online buzz, how many mentions did you get on social media? What is your earned media? How much do you have in terms of owned media? How many website visits? All those are reflected as sort of intermediate funnel metrics that ultimately lead to product market performance. And research in the space has shown that some of these are leading indicators of future performance. So by tracking these, you can sort of figure out what's going to happen to your sales down the road. And I'm happy to share with you some papers that look at these lead generation metrics and how they track into performance, not this quarter, because it takes time before this manifests in terms of financial market performance, but what happens, say, 6 months down the road, and which of these are better leading indicators than others, and so on. That's an excellent question.
Oh, we have another one here. Just a moment.
Okay.
So I'm fascinated in what you had to say about marketing smoothing out risk patterns,
Yes.
which is something that we've sort of played with a bit in the past. So how do you include in that the competitive context? So if you look at brand and marketing as a kind of beta added to a valuation, for example.
Right.
That has to be relative to competitive intensity and what competitors are doing, which I
Right.
don't think is on that chart. Yeah.
Yeah, that's a great question. One of the results I'm going to share with you has to do with a paper by Lee McAllister and colleagues from UT Austin, where she finds that advertising actually reduces the firm's exposure to systematic risk, that firms that advertise more can actually lower their beta risk relative to the overall stock market. And they also sort of have the share of advertising. They look at not just the own advertising, but advertising relative to competitors. And research has found that advertising can, in fact, insulate you from those downturns. So again, a paper by McAllister and colleagues has documented that. That's a good question as well.
And we have a question in from our Zoom people. It's from Jonathan Knowles. He asks, what conclusions does Shuba draw from the small number of studies that address pricing? There seems to be a bias towards value measures of growth.
That's right. I think, Jonathan, that's a great question. And as you will see from this chart, there have only been 3 studies that focus on pricing relative to the 300 odd studies. So, and there's a number of reasons for this, because getting granular price data has been challenging. And I think the jury is still out. I think there's more research that needs to be done on pricing before we can get solid generalizable findings that we have on the other demand generation activities. And I think with what's going on with inflation and increase in prices overall, I expect to see that there'll be a lot more research coming out. I'll share with you in a few slides role of price promotions, and maybe we can try to generalize from that, but there's definitely been more work on price promotions. So let me, hopefully that answers Jonathan's question, but we'll revert to it after we've talked about promotions. If you look at the methods, a lot of them have focused on event studies, because event studies have this nice causal interpretation. So then comes these models like persistence models and portfolio models, but largely a lot focused on event studies that lend themselves to causal interpretation. I'm going to sort of skip through this method slide. I think Neil may be in the audience. He has some phenomenal work on this topic, sort of a seminal paper where he shows that using Tobin skew as a firm value metric is flawed, and we agree with that. And so I'm going to, that's my nod to Neil's fantastic work, and say that most of these studies that use Tobin skew we should be cautious, but in general, other metrics such as stock returns are definitely better. Given the interest of time, I'm looking at sort of the interest in results. I'm going to sort of, again, skip through these method slides fairly quickly, except to say that the foundational model for the marketing finance interface space is the Farmer French Carhart four-factor model, which essentially says that the beta is that riskier stocks get higher returns, and Lee McAllister and colleagues showed that firms that advertise more are able to have lower levels of beta relative to firms that don't advertise as much. The SMB is that small stocks get higher returns than large stocks. The HML factor is that the return on high book to market stocks are higher than those that have low book to market. And the UMD is the momentum factor, but these are all things that are well known, and there's really no innovation here, except that we're able to take these models and now sort of investigate what's happening in the marketing finance space. 2 specific approaches that are very commonly used are the stock return response model, which builds on the efficient market hypothesis. And this has both causal as well as signaling interpretations. And I'm going to just leave that there. Let me skip to the, another model is the persistence model, which is used a lot. I'm happy to talk offline to those that are interested. But in the interest of time, I'm going to sort of go to the results, because that is the most important sort of thing for this audience, I believe. So what do we know from these 300 papers in terms of marketing's impact on stock price? Here we have all the variables that I had in my conceptual framework. First, I'm going to start with variables that have a positive finding from a marketing standpoint. Customer satisfaction, 12 positive findings, 0 negative findings, 9 neutral. 15 positive findings, 5 neutral findings, and no negative findings. Customer-based brand equity, which are brand assets, have mostly positive findings. Product quality has been shown to have a positive impact on stock returns. Financial brand equity, another variable that has a positive impact. And then comes the same brand equity metrics that we talked about that are early indicators, things like earned social media volume. How are consumers speaking about your brand on Twitter and Facebook, and how does that translate into eventual stock market performance? We find that a lot of the results here are positive when it comes to positive sentiment as well as earned social media volume. So the news is good for these marketing variables. Next comes the variables where you have mixed positive and negative findings, but predominantly positive. Advertising. We talked earlier, and I think in the very first session, about 50% of the advertising impact is not known, but here we see that advertising has mostly positive findings when it comes to stock performance. 5 studies find a negative impact. Alliances, configuration, mostly positive findings. And so again, for these variables, the news is good where marketing is contributing significantly to long-term value building through advertising expenditures and alliances. Then comes the set of variables with mixed positive and negative findings. CSR, for example, investors sometimes assign a negative value. I think it has to do with its interaction with corporate social irresponsibility, for example. R&D expenditures, most R&D expenditures, out of the 4 studies that we found in our literature review, it's a very mixed set in terms of mixed positive and negative findings. And then comes the set of marketing variables which have a strong overweight of negative effects. These are things like product recall actions, earned social media negative sentiment, and myopic marketing actions, which is the notion that marketers or firms that cut back investments in R&D and marketing and long-term brand building to boost short-term earnings. There's been excellent work by Music on marketing myopia, and she finds that such actions are actually punished by the investors because investors recognize myopia when they see it, and that is sort of punished in the stock market sense.
Could you give an example of alliances configuration?
Okay, alliance configuration might be an alliance between 2 brands coming together to sort of promote, co-promote with each other. I mean, one can think of brands co-branding with each other to sort of enhance the marketing value of each of the brands, and that is an example of an alliance. I think branding alliance is a good example, or companies coming together in international markets. Those are also examples of alliances.
So Shuba, is that the mixed effects, could it be because of lack of brand fit in the case of alliances? That's one question. Right. And my second question is actually more on the advertising expenditures. It's perhaps a little too simplistic to lump it all together in one bucket when all the debate is about performance marketing versus brand building marketing. So when you look at advertising expenditures, if it's skewing a lot towards those performance marketing, then you could claim that that's why the effects tend to be non-present or even negative, right? So could we get double click a little bit more into those two aspects?
Yeah, excellent. That's a great insight. In fact, a lot of the recent research has taken the advertising expenditures and broken down into things like paid search advertising versus display advertising. I have a paper that I published a few years ago where I showed that display advertising tends to behave more like brand building advertising. In contrast, performance-based advertising has more of a short-term effect. And it's precisely those kinds of insights that are driving the negative impact. So absolutely, you're right on. There's been papers. I have a paper that I'm happy to share that appeared in 2021, I believe. And then Rajdeep Grewal, Srihari Sridhar, and others have a paper that appeared in Journal of Marketing, where they disentangle the advertising expenditures into digital versus traditional and find that traditional sort of has a more brand building role and builds brands and has a long-term effect. But digital, depending on the type of advertising, particularly if it's sort of short-term click-oriented paid search type of advertising, that doesn't have the big lift that we're seeing from the traditional in brand building and long-term firm value. So right on, absolutely. And as to your alliances, I agree with that as well. It could be that brand fit is driving that, and some of those, absolutely, those negative effects are more nuanced, and the literature has a lot of moderators that might explain under what conditions the effects are more negative. Great insights. Happy to point the papers. Next comes the result on customer satisfaction. This I find fascinating. Klaus Fonell had a paper in 2016 where he looked at the cumulative returns of $100 invested in customer satisfaction. And the line on top shows that a portfolio based on just the customer satisfaction, or the ACSI, the American Customer Satisfaction Index, versus the S&P 500, which is the paler line at the bottom. So if you look at the portfolio based on customer satisfaction, that has a return of 518% compared to a 31% return on an S&P 500 portfolio. So here is solid proof that Fonell and colleagues provide that we as marketers have always, almost always known, which is that customer satisfaction is important because they contain information about the future of a business that is not picked up by current earnings and current performance. And we know this because we know that satisfied customers are likely to remain more loyal. Satisfied customers are likely to increase their consumption of the brand. Satisfied customers are likely to recommend the brand to others. There's less churn, there's more retention. All of this is going to influence future revenue generation and long-term firm value creation. And this goes at the heart of why it is really important for us to quantify these, which we know within the discipline, but I think we sometimes have a challenge communicating outside the discipline on the value of these metrics. Another study, work by my colleague Susan Fournier, comparing Interbrand's 111 world's most valuable brands to two benchmark portfolios. They find that strong brands deliver higher monthly stock returns with lower risk. Comparing Tobin's Q, corporate brands do better than Hauser brands from a point of view of both top line revenue advantages as well as bottom line cost efficiencies from sort of leveraging the corporate brand as opposed to having campaigns around 100 different brands. And this has been shown in a subsequent study where my colleague Susan and I, with a doctoral student, we investigated sort of the returns to a portfolio of investing $1,000 in firms with each of these strategies. For example, invest $1,000 in a portfolio consisting only of a branded house, invest $1,000 in a sub-brand, and we find that sub-branding, like say the Apple iPhone or brands that have a sub-branding strategy, outperform a house of brand. In our case, we found that the returns are $3,640 for a $1,000 portfolio relative to the other strategies which are in sort of the mid 100,000s. If you look at a house of brand, for example, the return is 1,540. Another question that came up this morning, and I think the study by Binder and Hanssens sheds value on this, sheds some insight on this, which is what's happening to the relative brand value of brands versus customers over time. And in their study, they look at 5,000 valuations that are recorded in mergers and acquisitions. And an interesting sort of takeaway from their study is that the brand value has been diminishing from about 19% to 9% in overall enterprise value, but customer value has been increasing from about 8% to 17% now. So you can see that over time, there's been a rise of the value of customer relationships, and some of this may be enabled by better data, and some of this is that brands are subsumed in customer value these days because you really need a strong brand to have the customer value. But an interesting sort of trend towards the rise of customer relationships. And this is where marketing, again, has a unique sort of lens into understanding and gauging the value of existing and repeat customers. And so it sort of further strengthens marketing's standing within sort of within the field. Another set of insights on the elasticities of marketing and firm value. There's a classic paper by Edeling and Fisher, which quantifies these elasticities. And an interesting finding from their paper is that advertising to firm value elasticity is typical what we see in sort of the product market space, 0.04, not very high, but mirrors what we see in terms of sales response. But again, what we see is that customer relationship assets have about twice the elasticity of brand assets when it comes to the impact on firm value. So essentially, this means a doubling of a customer relationship asset would increase firm value by, let's see, 0.72%. Yeah. And so again, it shows that customer relationship assets trump brand assets when it comes to the relationship between marketing and firm value. The last couple of slides have to do with product innovation and firm value. Here we looked at how long does it take for investors to understand what is the impact of new product innovations on firm value. The Honda, for example, the 1999 Honda Odyssey was introduced as a fully redesigned Odyssey. And in this case, it took about 10 weeks for the investors to recognize whether this product was going to be successful or not. So after about 10 weeks from the new product launch, you can see that the firm value impact is fully reflected in terms of the impact on the capitalization ratio of Honda. So this is where, again, marketing sort of leverages the efficient market hypothesis in that new information as it becomes available is incorporated by investors. And in this case, this was publicly available information because Honda was having these weekly sales calls, sort of announcing the sales of the new products as it was being launched in various parts of the country. To Jonathan's question, the one variable where we see a negative impact on firm value is the role of promotions or price cuts. If you think of rebates or promotions as price cuts, you see that investors actually don't respond favorably to price cuts. In 83% or roughly 80% of the products where there was a price cut, investors punished the firm with a negative impact on stock prices. And this is because, I guess, investors not only look at the top line revenue performance, but also understand that price cuts means that margins are lost and baseline revenues are being subsidized by sort of these price cuts. And so promotions are one space where we see these consistent negative impact on stock performance when firms are in a sort of a promotion business. But what's going to be interesting to see with all the price hikes that are going on with inflation and the fact that brands are able to sort of pass down these price cuts, it'd be really fascinating to see how investor response sort of reflects what we're seeing in the current era of price increases rather than price cuts. A few other results that are really rapidly emerging are in the space of digital marketing and firm value. I've talked a little bit about this, the role of online social media. There's been a lot of work on data breaches. Every day we see data breaches and we find that these are having negative impacts. The other details are in my paper. I'm going to sort of go to the summary slide, which is that synthesizing everything together, marketing assets have a positive and substantial impact on firm value. Product innovations generally have a positive impact on firm value. Price promotions can have a negative impact. Digital marketing, as the Q&A pointed out earlier, is a little more nuanced. Some of them have positive impacts, which are those variables that build brands in the long term, whereas those that are very performance-based or short-term oriented could have don't have the same positive firm value effects. Product recalls, a lot of what we're seeing in data breaches can have a negative impact. Employee satisfaction is now being viewed as almost as important as customer satisfaction in driving firm value. And there's a lot of work outside of marketing in HR and other domains on employee satisfaction. CEO and CMO characteristics. For example, CEOs with marketing expertise or CEO tenure. How do firms which have a CMO, research has found that firms with a CMO do better in terms of firm value than some firms that do not have a CMO. So the role of marketing expertise in driving some of these outcomes has also been documented in terms of the impact on firm value. And the role of reverse causality, which is the notion that sometimes managers respond to these stock price movements and those have good outcomes. There's been a recent paper by Chintagunta and colleagues where they show that pharma managers that don't know what their true demand is going to be for their drug sometimes look at investor reaction and adjust their advertising or up or down depending on how investors react to the new product launch. So these are all topics that are growing as well.
And we do have another question in on the Q&A.
Yeah.
It is, in the Binder and Hanssens study, the sum of brand assets and customer assets has remained stable over time. Should we conclude that brand equity and customer equity are two sides of the same coin? And as Shuba remarked, the change in proportion may simply reflect the increased ability to attribute to the customer relation, CLV, what was previously attributed to brand equity.
That is an excellent articulation of what I was trying to say, Jonathan, and I completely agree. I think the sum has remained stable over time, and I think what we've been seeing in the last decade or so, I think since the time of, over which we saw that shift, was the availability of better data on customer metrics. I mean, the data revolution of the last 10 years has just meant that we are now able to better measure customer lifetime value. And so a lot of it was attributed to brands. And I think there's certainly a measurement piece to that. And the second is, I think, the emergence of the digital e-commerce companies, which really are all about customer, initially start out by focusing on customer assets and then the brand follows. So I think there may be two things going on, the new emergence of digital channels as well as the measurement that you rightly alluded to. And it'll be fascinating to see if we can sort of see how much each of those is driving these effects.
Can I ask
Excellent point.
Can I ask
Yeah.
a sort of add-on question to that, which I was thinking exactly the same thing as Jonathan.
Which is, how do you, since they're so intertwined, how do you define brand equity versus customer equity? What's the difference? Which asset is which?
That's right. That's a great question. And I think customer equity in this stream of research is generally defined as the lifetime value of the net present value of the future cash flows from your current and acquired customers. So if you think of all the current customers and your future acquired customers, what is the net present value of the cash flows that you accrue from them, sum them up, and that's the customer equity measure. So it's all about the customer perspective. The flip side is, as Jonathan rightly said, it's about brands, which is the lifetime value of cash flows accruing from each of your brands. So to the extent that these are opposite sides of the same coin, that you are brands without customers are meaningless and customers without products or services or brands are meaningless, it's really measuring sort of the two cash flows, the cash flows accruing from brands and customers. And I think they are sort of mirror images in some sense of each other. Does that help?
Yeah.
Okay.
Oh, we have another question. Just a moment.
Yes. Yeah, these are excellent questions.
This is not a question, but more of a clarification.
Yeah.
Shuba said there are two sides. You might want to think of it as a matrix. You have customers on the rows and brands on the columns. The sum total of the matrix, the columns, the grand total will be the same, except that one brand will cut across all customers and will have a brand equity. Another brand will have another brand equity. And this way, you know, a customer can have multiple brands, and similarly, a brand can have multiple customer groups. So that way, the firm value will be a sum total of the intersection of brand and customer value.
Thank you, Venki. That's very helpful. And I think if you're interested in sort of the matrix, Lehman and Riepstein have a Marketing Science Institute book where they actually lay out this sort of the 2x2 rows and columns that Venki was talking about. And it might be very helpful to look at that as well. It's been out for a number of years now. It's called Marketing Metrics, I believe, the book. And that's sort of a useful way to view the brand and the customer equity picture.
But I do think this is something that needs, that bears a lot of sorting out, because there's so much discussion about the two, and sometimes the way they're juxtapositioned, you see that it's brand assets versus customer assets, which is like, it's a false dichotomy. You know, when you say brand assets going down, customer assets going up, it's actually not like that at all, really.
That's true, Joanna. And also customer satisfaction was one of the drivers. There's no customer lifetime value if you do not have customer satisfaction. So there's a little bit of like interaction between these things.
Sorting it all out.
That they are not completely distinct. But Shuba, my question was a little different about innovations and the fact that there were some innovations that had negative effects. So I'm wondering, is there a double click possible to, I mean, we would think that firm that is on the cutting edge of technology is awarded in the marketplace, and innovations are a way of communicating that you're keeping updated with state of the art. So when you see negative impact, it is calling out some failures. So is there anything more that can add color to what kind of innovations are impacting negatively?
That's a great question. I think some of that innovation research that I did came from the automobile industry, and I can give you an example from one of the innovations. Pontiac came out with a car which is called the Pontiac Aztek. I don't know if any of you remember this. That was something that we covered during the data that we had, and that was an innovation that had a negative impact. It was a really ugly car that did very poorly in terms of the appeal and the quality scores, and it was distinctive. People noticed it, and but investors said this is not something that they sort of rewarded with an increase in stock price. And you're right, the innovation results are more nuanced. In the same sort of stream of research, we found that pioneering innovations, like the first gasoline hybrid when it first came out, or the MD. I think it was the Lexus RX 300, which was the first SUV on a sort of a car platform. Those kinds of innovations that were pioneering were rewarded much more than sort of Me Too innovation. So there's a lot of work on innovations that I think some excellent people like Alina and Surescu and her colleagues, and Venki and his colleagues have some really good work that sort of takes that stream of research forward. But yes, there are moderators, and it is very nuanced. And yeah, I think that's what I have to say. I don't know if anyone else on the call has insights that they want to jump in on.
I have been curious over time. There used to be a paradigm which was often, repeated in business schools and then kind of driven into junior executives, which was to concentrate on both trial and repeat. This whole concept of acquisition versus customer satisfaction of the base. It's funny because once market mix modeling came out, the repeat became base volume, and people started thinking of it as, maybe to a detriment, that you didn't have to support that anymore. That's just something you automatically get, and it makes me wonder if there might not be something we can do from that perspective of getting back to a paradigm like trial and repeat or something similar that will give this broader sense and into meaning of that marketing just isn't about acquisition, though that's a very important portion, but it's also about driving those your existing customers to have a deeper relationship with you and and increasing their sales and the real options of leveraging your brand into other new segments or categories. So anyway, so you asked about suggestion. That's a thought.
Yeah, that's an excellent comment, and I think that I'll point you to work by Dan McCarthy at Emory and Pete Fader and colleagues. Dan has been doing a lot of work linking some of these metrics that you talked about, such as churn and retention and acquisition metrics, to understanding the firm value of new startups, for example, and he finds that these are actually very good predictors of firm value. And really cool work that's being used a lot in the private equity space to understand how to look at sort of the trial and repeat or sort of churn, acquisition, retention metrics, and how to drive more volume with your current customers versus acquiring customers. And really seminal work. And maybe that he's a person the MASB could have at a future conference because he's doing some really cool work in that space. So let me conclude with this last slide. In the next 10 years, we hope that the marketing finance interface field reaches across aisles to collaborate with other disciplines. It gains more traction with regulatory agencies, and this is where the MASB, I think, could play a really important role, and the MASB has been at the forefront of this in terms of driving marketing and customer disclosures. Transform these methods into tools that are practically implementable by professionals and widely used across industries. And here's where I think the academic discipline is looking for partnership with MASB to gain more traction around disclosures on marketing and customer related issues and sort of elevating the stream of research so we can have tools that are implementable. So with that, I'll stop. I think you said I had time until 2:05. I see that it's 2:03. So maybe time for a question or two, Eric, if we have it. Okay, thank you very much. It's been wonderful, really wonderful questions. And once again, I apologize. The timing of my COVID, I sort of put it off for 2.5 years, didn't get it, but it just happened to hit me. But it was mild and it's almost gone. So thank you again for your time and these wonderful questions. Really enjoyed being with you today.
Thank you so much. We enjoyed having you.
Okay. Bye, everyone.